Hello there and welcome to our investment process video where I'll take you through the investment process we use at McGregor Wealth Management. So this video has been specifically designed for you if you are a long-term investor, if you've got a goal, if you've got goals and plans to achieve financial independence and a great retirement, if you want to make good, smart decisions about money, if you value good professional advice. It's designed for those who've watched our video series and who've had a wealth potential appointment. Now, if you haven't watched the video series, you can access that via our website. That's McGregor Wealth Management. And the same with if you haven't had a wealth potential appointment yet, you can book that appointment through the website as well. So this has been specifically designed for those people that are working through our planning process with us. It's not designed for, now it might be useful and you might learn something, but it's not designed for those who don't have a plan yet or who aren't clear on their long-term goals. Those people that are speculators and traders, and I'll talk a bit about definitions shortly, and those trying to get rich quick, good luck. I've found get rich slow works really, really well. Get rich quick is very much hit or miss, and miss for most people. And just a warning, everything that appears on this, this video is general advice. It doesn't take into account your specific circumstances. Our financial advice to you will take into account your specific circumstances, and you shouldn't act on advice in this video until you get your statement of advice. My name's Rob McGregor. I'm the founder and principal of McGregor Wealth Management. We've been helping people build their wealth, preserve their wealth and manage their wealth and make smart decisions about money for nearly 20 years. Our clients are both those who are growing their wealth. They all share in common a desire to have confidence and clarity in a great retirement. I'm a licensed representative of GPS Wealth, who are an Australian financial service licence holder. Let's get into it. What we're going to cover in this video, we're going to cover the mission of your investment. So what's the purpose of the money you invest? We're going to have a look at the big challenges to having a good investment strategy. And unfortunately, there are lots of challenges to both developing and maintaining a good investment strategy. We're going to have a look at how most people, including many professionals, mess it up, and particularly at how you cannot mess it up. We're going to have a look at the 4 foundations of a great investment process, and we're going to look at how to put it all into practice for you. So let's firstly get into the first one, and that is the mission. What is the purpose of your investment? So why do we have investments? So we build a pool of investments, and we build this slowly over our lifetime, but eventually we want enough investments that are going to pay for our living expenses, that are going to pay for the nice things in life, that are going to pay for our passions and pursuits, and these are different for all of you. So as part of our planning process, we always take the time to understand who and what's important to you and make sure that that's factored into the goals around your plans. Your investments also have to pay and allow you to help those who are important to you. That's family, friends, other organisations that are important to you, and potentially to leave a legacy. So that's the mission of the investments, a very important mission, and very important that we get the investment pool right to achieve that very important goal. So let's have a look now at some of the big challenges, and as I said, there are many, but let's look at the big, what I call the big 3. Firstly, it can appear very complex. If you start to get into this, there's so much jargon, so much terminology, so many experts, CNN run 24/7, there's books, there's all sorts of things and all sorts of information going. So it can appear very complex, and in some ways it is complex. Our role, and my role as an advisor, is to make the complex simple, not the other way around. So it's to understand the complex and then make it simple for you. Now, secondly, we're not designed to be good investors. Our brain was developed during our caveman stages, and it's designed to look for fear, way more than it looks for opportunity. When we were cavemen, a rustle in the grass, a movement from something we couldn't see, a sound, often meant there was a potential we're about to get eaten, we're about to die. So it was very important that we react. And the 3 reactions that we had in those days were fear, fight or flight. And unfortunately, in the modern world, we have lots of things that trigger those same reactions when they're not always the best reaction, because we're not about to be eaten and we're not about to die. So we've got to make sure we both train our brain, the rational brain part of it, but also understand those triggers about what they are and what they aren't. And we'll talk more about those. And the other's not being clear on the definition or purpose of what we're talking about. And let me dive deeper. So we use these words interchangeably sometimes, some of them, but it's very important we define what they all are. Now, you will have seen our investment beliefs document if you're coming through our process. If you haven't, you can access that on our website as well. But very important that we define these terms: saving, investing, speculating and gambling, and not mix them up. So saving is where we're putting money aside to eventually buy something. Could be a house, could be a car, could be a holiday, could be anything, but we're saving to spend. And we're saving and putting money aside for the unexpected, so emergencies. And saving is a great thing, but it's generally done by putting money into a bank account or an offset account or a short-term investment that doesn't carry any volatility and doesn't carry any risk. So important to define saving. We then have investing, which is buying good assets that produce rising income to build wealth. So that's my definition of investing. The important part there is buying assets that produce income that are going to build wealth. And it's the rising income that actually causes price to rise, whether that be on good quality property or good quality shares. So they're going to be an important part of your investment strategy. Speculating is buying things where we think, that is, we hope the price is going to go up. So that is often things that don't produce income. Could be gold, could be Bitcoin, could be artwork, could be antiques, but things that don't produce income where we hope and believe the price might go up, and that's speculating. And then ultimately there's gambling, where we place a bet, and if we're right, we win money, and if we're wrong, we lose all of our money. So what we advise people on is investing to achieve their long-term goals. It doesn't mean, we also advise on the saving, but it doesn't mean you won't do some speculating. It's very important to name it and limit it to money that you can afford to lose. And the same with gambling. Gambling with money that's entertainment value or money you can afford to lose, nothing wrong with that. But as soon as it steps up into to trying to serve the purpose of saving your investments, then it's very dangerous territory. So that's investing. So let's look at the 4 foundations to a great investment strategy. So, and it's very important that we have strong foundations. So the first one is that all investments should be made as part of a personal financial plan. The second is that we should learn from history. History leaves us a lot of clues. History won't repeat exactly, but it's very important that we understand history, particularly around investments, economies, and those types of things. It's important that we understand and manage those behavioural traps. So this is our mind. This is the tricks our mind plays on us with our prehistoric brain, and understanding that and being ready for it so we can catch ourselves and avoid the traps that most people make. And very important that then, once we've got all those under control, that we invest smartly. There's a lot of academic research, there's a lot of history on how to invest smartly. Unfortunately, most people don't do it because of all those other issues. So let's dive in firstly at financial planning, or your own personal financial plan. And we, in the GPS world, actually use GPS as an analogy. So the GPS you have in your car, or these days on your phone, you put in where you want to go, it knows where you are, and then it tells you step by step exactly how to get there. That's what a good financial plan should do too. It should start by establishing your goals, and those goals are going to be based on who and what's important to you, your lifestyle, your retirement plans. And we take the time, as we've done with you or are about to do with you, to make sure we've got those goals crystal clear and they're absolutely based on who and what's important to you. So we know the mission for the investments. Then we develop a plan to achieve all those goals, and as part of that plan there's lots of strategy on things like wealth creation, superannuation, saving, paying off debt, tax. But one of those strategies will be a smart investment strategy to help us build that pool of investments to achieve the mission. So that's personalised planning, that first foundation. And the key insight there is that all investing should be done as part of a long-term plan. Now, the second foundation is learning from history. And I'm going to take you through a quick history lesson. I use the index chart. For those of you that have been in the office, you'll see that's in all our offices. And we use this to remind ourselves of the patterns of history. They don't always repeat the same way, but we repeat the same patterns over time. And this chart from Index shows a series of coloured lines. The bottom line there, the red line, is inflation. And this chart goes back to 1950. This particular one is 2015. There's more up-to-date ones in my office, but this one gets the message across perfectly. So inflation during that period averaged about 5%. Now, there were some low periods of inflation like now and in the 50s, and some high periods of inflation during the 70s in particular, but also the 80s. So 5% on average, and that meant the value of $100 back in 1950, it now takes $2,600 to spend what would have taken $100 in 1950. Now, if you put your money in the bank which is the grey line, you would have achieved a return of around 6.6-ish%, so about inflation plus 1 and a bit percent. So in the current inflation world we're in of about 2%, that explains term deposits of just over 2%, nearly 3%. And the green line is bonds, so about inflation plus 2.5% or 7% there. Then the light blue line is a balanced approach, so that's some bonds, some shares, and some property. And the dark blue line is shares, which achieved a return of around 12% or inflation plus 7%. So during that 50-year period, you'll see those different returns. Now the dark blue line, the shares, is the most volatile, so it goes up the most, and you'll see $100 would have turned to $161,000 during that period. Now, eventually, you're going to settle on what we call a risk profile, and it's going to be somewhere in that range of the green to blue lines, depending on the compromise between your approach to risk and what you need to achieve your goals. So let's get into some of these first lessons from history, particularly around the share market, which will be an important part of your portfolio, no matter what risk profile you have. So the first lesson is the market does go up more than it goes down in this time, and the facts here are about 3 to 4 to 1 up. So the market goes up between 3 and 4 times more often than it goes down. Now it does go down regularly, and sometimes it goes down by a lot, and we're going to talk about those downturns shortly. When you look at the long-term perspective, it always recovers eventually, and you can never predict what it's going to do in the short term, but you can pretty much predict what it's going to do in the long term, and that's continue to do what it's done in the past, and that is go up, but along the way it will fluctuate. There's a really good perspective here, which actually goes back to 1900. So if your great-grandparents were wise enough to put $1 in the share market back then, it would be worth $281,000 today if they just left it. It would have gone through the occasional bit of turmoil, which are those red dots, and they're the ones we'll talk about shortly on how to manage your affairs during those times and how to be ready for them. But overall, if you let it just grow, you would have had some really good results. So let's have a look at one of my favourite strategies to deal with volatility. We call it dollar cost averaging. So dollar cost averaging is just an investment technique that puts money into an investment, in this case a share-based fund or investment, bit by bit. Now, as we said, we're not designed to be good investors, so let's have a look at what happens if we start a dollar cost averaging program. And in this example, we're going to invest $1,000. Now, the price of the share or the fund that we're investing in is $1, so we get 1,000 units. So quite simple maths there. We've got $1,000. We put $1 in, we get 1,000 units. Now, as I said, we're not designed to be great investors. If this was today, we logged onto ComSec or some online stockbroking advice and we spend $1,000 to buy some shares, and then we go off, get busy about our day, we go out to lunch, we come back from lunch, and we've got 5 minutes spare. What's the first thing most people are going to do? And that's right, they're going to check the price of that investment. It's only been 2 or 3 hours, but already you want to see what it's done. If it's gone up, we say, wow, we're doing well, we're making money. If it's gone down, we say, oh, not so good, maybe we should have waited. So we're looking at the very short term when we know we're investing for the long run. So let's have a look at, we know we're all good when it goes up, let's have a look at what happens when it goes down. And this is an exaggerated example, but I want to get the point across about what happens in the real world of the markets. So in this case, the price of the investment or the market has gone down 25 cents or 25%. Now, if this was, let's say, an item like a pen, and initially we were buying pens for $1, but the next month the pens were selling for 75 cents, what would the sign outside the pen shop say? It would say pens on sale. But what would the media say when the market's down 25%? It certainly doesn't say on sale. It says things like major downturn, and we'll look at some of these headlines shortly, but it's a projection of negativity. The good thing is we're getting more for our money. So if you look at those number of units, we're now getting 1/3 more. So we're getting 1/3 more units because the price is 25% off. Let's say it gets worse. And this is effectively what happened during the GFC. The price over a 9 to 12 month period dropped, or the market dropped by about 50%. So we're now getting twice as much for our money. The newspapers should be saying, massive sale, get in quick. These prices will never be repeated during your lifetime, but they don't. They say things like global meltdown, depression, the end of the world, And it's not the sort of thing that gets people excited about investing. Quite the opposite. Most people are likely to dump their investments right at the time where it's the most opportunity. Now, eventually the market goes up, and we have this disciplined approach called dollar cost averaging that we're doing. So we just keep investing every month. Another $1,000, we buy another $1,333 as the market recovers, and eventually in this exaggerated 5-month period, the market's back to $1 and we're back to buying 1,000 units. So in this exaggerated 5-month period, we've spent $5,000. The market's gone from $1 to $1. So if we looked up the Sunday performance, the Sunday papers on the performance of this investment, it would say it's done nothing. It's gone from $1 to $1. But what's happened with our strategy? We've accumulated 6,666 units. They're worth $1 each. So we've got a value of our investments of $6,666. We've actually made about 30-something%. So the market during that time has done nothing, but our strategy has made 33%. So it's very important to recognize that everyone's individual strategy is different than the performance of the underlying investments. Now, all that's had to happen in this example was the market went down and then it went up and it eventually got past where it recovered, which is something the share market does every single time. Sometimes it takes some time to do that, and we'll have a look at some of that. But you can see in this example, the market has gone down, and every single time it's gone down, it's gone back up and it's eventually gone past. So the market's made those Vs. So during every one of those downturns where you're dollar cost averaging, you're making money. And it's an important reason why shares and well-diversified shares, as we're going to talk about, should be part of your long-term strategy, and why dollar cost averaging through either your own money or even with borrowed money will work to minimise volatility, and you'll actually get a better return than you would from lump sum investing through those downturn periods. So let's have a look now at how most people mess it up. And the letters in mess it up actually stand for the ways they mess it up, and I'll take you through that shortly. But they all fall into 3 main ways. Firstly, they may not take enough risk to get the return that they need. So they're too conservative, invest in term deposits or risk-averse conservative investments instead of long-term investments like shares and property. They may take on too much risk, may do things like speculating or gambling and eventually blow up their money, or they fall victim to the behavioural traps we're going to talk about. And one of those is they actually bounce between the first and the second, doing them at exactly the wrong time. So let's have a look at the result of them messing it up over time. So the number one contributor and the number one detractor from your investment performance are not necessarily what you think. Everything, traditional portfolio, there's a body of science called modern portfolio theory, which has done loads of research. There was someone called Harry Markowitz who won a Nobel Prize for it in the 70s. So lots of theory. And the theory says that 90% of your long-term return comes from your asset allocation. So that's how much in shares, how much in international shares, how much in property, how much in bonds. And 10% comes from timing and selection. So that's which manager, which company, when do you buy, when do you sell. Now that is true if you ignore our behaviour, but in the real world, that ignores that number one influence, which is your behaviour. So that's what you actually do. And the fact is most people don't just buy and hold their investments. They actually buy, sell, trade, get out at exactly the wrong time. Now, the biggest risk, therefore, is our own behaviour. There's a research study in the US called the Dalbar study, which has looked at this for years. Here's an article from Forbes magazine in 2014, which looked at the then results of that year's Dalbar study, and it's got a nice graph, which I like, which shows it quite well. So you can see during that 10-year period, shares, and this is an American study, so American shares had done about 7.4%, international shares about 6.9%, and bonds had done about 4.6 to 4.3%. Now, a balanced investor who was investing 50-50 in shares and bonds should have got somewhere around 5.5 to 6%, but they actually got 2.6% because they burnt up most of their return by jumping between shares and bonds at exactly the wrong time. So here's another way of looking at that from a later version of the Dalbar study, 2015, which showed up to 2014. The green bars here show the returns that the share market got. The red bar shows the returns that the average share market investor got, and the returns are not the same. In fact, they're nearly less than half in all cases. And this study's been going for 30 years now and shows unequivocally that people investing without taking into this account can blow up half the returns that are available because they do the wrong things at the wrong time. So once we know that our behaviour is important, we can then say, well, if 50% of our return comes from our behaviour, then we add those other factors, asset allocation, which would account for about 45, and timing and selection 5. So 95% of our long-term return we can control, we can manage by managing our behaviour and having a good asset allocation. Then we can pretty much ignore the timing and selection, which means chasing hot funds, chasing hot stocks, speculating, etc., because it's not going to make a difference, and in fact it generally takes away from our return. So a key insight here, that returns investors get are very different to the returns that their investments get. So let's have a look now at the ways people do mess it up. So firstly, they rely on the media. Now the media is 90% negative. I ask people in seminars on this what percentage they think, and it's 90 to 100. It doesn't always be that way, but the media knows for you to pay attention to them, to buy their media, or to click on CNN, or to watch online, that they need to be negative. You'll see this with natural disasters, you'll see it with any crisis, you'll see it with bad things. They want to replay them often to make you pay attention. Look, here's a typical headline you'll see about the market. $24 billion wiped off ASX amid whatever. It doesn't matter what they put next, it's actually irrelevant. How often will you see them have a headline that says $24 billion added to the market today due to whatever? And yet that happens 4 times as much as the downturns. And what does 24 billion mean? It doesn't actually mean much in the context of the total value of all Australian companies. Let's have a look at another headline. This was from 2008, in the middle of the GFC. So Britain had announced they're in recession, and the headline here was Britain faces the worst recession since the 1990s. And since 1993, when we'd had the last recession. Now, automatically, what do most people think? What does their prehistoric brain do when they see headlines like this? They actually want to get out of investments. They don't want to invest. So if you look at this chart and you'll see those light blue lines, these are recessions we've had in Australia. So let's get some arrows onto this. Where I'm pointing at here is where recessions would have been announced. So what's the definition of a recession? It's 2 negative quarters of GDP growth. So by the time they measure that, count it up and announce it, we're generally about 8 months into a recession. And if you look at where the bottom of the market occurs at each of these red arrows, it occurs pretty close to about when they're announcing recession. So if you did the opposite of what your prehistoric brain wants to do, which is run and get out of shares when they announce a recession, and actually bought more in a recession, you would have done very well indeed. So it's a great example of ignoring the media. So the media drives our emotions, and as I said, that prehistoric part of our brain, which is not the way to make investment decisions. We need to make them rationally. But it's because we tend to focus on short-term and single-issue obsessions, short-term issues, and some of the short-term and single-issue obsessions we've had in the past. Things like the Greek crisis, the Russian crisis, the Asian crisis, pandemics like bird flu, SARS, all these things, and many other political situations that in the long run disappear very quickly and make no difference whatsoever to our investments. Donald Trump's one at the moment. And these things, while being important to our news, are not as important as we think to our investments. Illiquidity, that means not having enough cash or reserves, and there is only 3 ways to lose money from the share market, and that is if you panic and sell because you're scared, driven by the media. The other is if you have to sell because you don't have enough liquidity to pay for the stuff that you need. And the last one is if you're not truly diversified, and I'll get to that in a minute. So timing and selection, we all like to think we can time the market and pick funds that are going to outperform, but all the research shows that nobody can. And greats like Warren Buffett also talk about how this is impossible. In fact, Warren Buffett had a bet back in 2007 actually, with the leading hedge fund managers in the world. So he offered $1 million bet to say he would not even invest himself. He would just invest in an index-based fund for the share market. It was a Vanguard S&P 500 fund, and they could put up their best hedge funds and that he would beat them. Now, and you can see the blue line is the Buffett investment, which was just left to sit and forget in the share market, and the red was the hedge funds. And at the time of this slide, Buffett was so far ahead with that passive strategy. You can Google Warren Buffett hedge fund bet and you'll get where it finished, but he finished so far in front and made a whole lot of money for charity. Warren Buffett actually encourages regular investors to invest in index funds, and it's something we do as part of the process you're about to see. That other one we talked about, that third way to lose money, lack of diversification. So that's where people get too focused on individual stocks or individual markets or individual themes and not be truly diversified. And the other one is focusing on performance. And performance is always historical. And you've seen the guarantees. Past performance doesn't guarantee future returns, but we can't help but look at it, unfortunately, and it drives us to make bad decisions because we see a fund that's performed well and we want to put more money into it, or want to put our money into it. We see a fund that's performed badly and we want to pull our money out of it. So what are the odds of us picking a successful fund? So Vanguard has done some good research on this, and this was some research that showed Morningstar have a rating system for managed funds. So lots of advisors, lots of investors use this, and they rate the funds 5-star, 4-star, 3-star, 2-star, 1-star. So 5-star in theory is better. And this first chart shows the cash flows going into the funds, and you can see that more money goes into 5 and 4-star funds, and it's coming out of the 1, 2 and 3-star funds. Now that should be a good thing, shouldn't it? Well, let's have a look at what happens in the next few years. So in the next 3 years, 36 months, this is how the funds performed relative to each other. So the 5-star funds actually underperformed the 1-star funds. And you can see it's perfectly correlated with the higher the rating, the worse they perform. Exactly the opposite of what should be happening, which is why it's very hard to rely on these performance figures. And what are the chances of picking funds that are going to outperform? Well, it's about 4%. I'll put that into perspective in a minute. So this was a research Vanguard did on all managed funds. So in US equities from 1999 to 2014, so a 15-year period. And they split them. They wanted to find out how many funds had survived, because most of the funds didn't survive. In other words, they merged, they closed due to lack of performance or otherwise, and never experienced 3 consecutive years of underperformance. Now, this is important because what are you going to do, and what are most people going to do if their fund has 3 consecutive years of underperformance? And we all know it. We're going to get out because of that. We're going to think that the fund's broken. We're going to get out. We're going to go and do something else, often another high-performing fund. So less than 23 funds survived, outperformed, and never experienced 3 consecutive years of underperformance. Now, 4%. So 4% might sound like good odds, but let's put it in perspective. I've got a couple of cards here. What game am I playing? Blackjack is the game. So if you were dealt these 2 cards, what would you do? And let's assume you can't split them. So those cards, for those of you that don't know blackjack, add up to 20. So only 1 card can save us. Most people would stand. In fact, everyone would stand unless they were absolutely punting, gambling, and trying to get lucky. So what are the odds of getting an ace, which is the only cards can save us? It's 8%. So 8%, it's twice as much as the odds of picking a managed fund that's going to outperform, survive, and have less than 3 years of underperformance. So, and yet it's something professionals and amateurs do every day, and it's something we shouldn't do. And that's why index investing is a much better way for most of your money. And we'll get onto that shortly. So the cost of that bad behavior, if we look at it from the person who has a lump sum, firstly, let's say someone who's got $1 million who's pulling out around $45,000 a year, they're earning 6%, and the green bars show that their value's staying stable. If they make bad decisions, either being too conservative or chopping and changing, as per the Dalbar study, we can assume they're going to get half that return. So if they got half that return in that drawdown stage, they're going to run out of money in 23 years. So instead of having in 23 years, $1 million or nearly $1.2 million in future value, they're going to have nothing if they just kept pulling the money out. So it's $1 million consequence of burning up and making the wrong decisions for someone in retirement. What about while you're building wealth? And this shows a very simple example of a 30-year-old investor who's only earning $50,000 and who's just putting in the superannuation guarantee, and when they earn 6%, 8% or 10%. And in the real world, if they're chopping and changing, they might only earn 4 to 5%. So 10%, they're nearly 1.6 million. So it's nearly $1 million more over that 30-year period. So these things make a massive difference on your future, and very important to get them right. So the long-term return is absolutely critical. So let's have a look now at another perspective on looking at investments. So you can see here what we're all scared of are the big downs. But if we fell asleep, if I've gone back here from the bottom of those markets, I've gone back in each of these cases 2 years and then forward 5 years. So in that 5-year period, it's pretty boring. But what happened is the market went up very hard in all cases first, and then it came down back to gravity, back to normal. So the key understanding is before any of these major downturns, the market's always gone up hard first, and that's the irrational bit. And if we're long-term investors that can smooth that out with our strategy, but also with our behaviour, then we avoid the issues that go with that. The market goes through 3 stages. So one of those stages is fear, and that's what happens in all these cases when the market's gone down. And we know from what we've talked about in this video, our natural reaction, our prehistoric brain when we hit periods of fear, is to fight, flight, and that means we're going to get out of our investments. And that's the worst thing we can possibly do, and that leads to the results that come in that Delbar study. The market goes through FOMO stages. For those of you that don't know, and I'm assuming that's not many these days, that's fear of missing out. So it's a modern term. We're all scared of missing out. That's why Facebook exists, to show us what we're all missing out on. And yeah, you can see that run up in the markets in all those cases where the market gets silly. That's where everyone you know is making money. It's a hot topic at dinner parties, in this case the share market. I've worked in stockbroking years ago. It's when the taxi drivers would ask you when you left work for the day what different stocks had done, and we're certainly not in that stage at the moment. So fear, FOMO, and the rest of the time is just what we call the wall of worry. That's where all those other periods where the market just keeps going up with little periods of downs as the market wrestles between, are we overvalued, are we undervalued? Is Trump a good thing? Is he a bad thing? What's the Asian crisis mean to us? What's the Greek crisis mean to us? It's the wall of worry where good companies keep doing what they're doing and making money and the market goes up. So if we can always be aware of those stages, we can have strategies that deal with those stages, both investment strategies, but also behavioral strategies on things what not to do. So smart investing, let's get into it. Firstly, getting the structure right. Low cost and tax efficient index funds do this brilliantly, and it avoids us chasing performance, which as we've seen is one of the ways to lose money and be subject to those behavioural traps. So index funds are low cost and much more tax efficient. A strong methodology, we have an investment methodology called CARE, which I'll introduce you to in a minute, but one that's based on smart principles, that has strong values, and that has stood the test of time. You don't want to be working out what your methodology is in a crisis, because naturally you'll hit the panic button if you don't have confidence in your methodology. Then ultimately, once we handle the behavioural issues, it's back to that asset allocation driving 90%. And rebalancing, I'll touch on that in a minute. It is probably the only potential free lunch in investing. And time in, it's letting the markets do the heavy lifting and letting the investments grow over the long term and not trying to time the investment. A bit more detail on a couple of these. As I said, that's that guy, Harry Markowitz, Nobel Prize winner in the 70s. And he came up with the concept of diversification. And that was, as you diversified, you actually decreased your risk. And that's not putting all your eggs in the one basket. Another definition of diversification, which I love, is diversification is bargaining away the right to make a killing in return for never being killed. So that's where we never attempt to make a killing and we'll never get killed. Asset allocation is simply designing how much goes into each of those asset classes, and it aims to balance the risk for each of you. And rebalancing is where we keep, once we've got our asset allocation, on a regular basis, we rebalance that when it gets out of whack, as it does because all the sectors are performing differently. The research shows that rebalancing adds between 0.5% and 1% to your long-term return. So it generally pays for advice completely in the process of managing your portfolio. So let's put it all together. Firstly, we need a GPS plan that's based on your goals and who's and what's important to you. Wealth creation strategies, and they're things like, so the superannuation, the investment property, etc. Separating the investments that you personally manage, and some of you will want to manage some investments yourself, and the property investments, and that's always individually tailored. And then constructing your investment portfolio using our CARE investment process, which I'm going to introduce you to. That was some of those strategies. My apologies, the timing of those bullet points didn't come up right, but they're just some of the wealth creation strategies. So let's get into the portfolio construction and our CARE process, which is designed on everything I've talked about so far. So it's where we put 4 strategies at work. We break your investments into 4 buckets, if you like, and the first letters in those bucket names make up the symbol CARE. It's based on those 4 foundations that we talked about, the base of that being personal planning, the lessons from history, managing investor behavior, that's your behavior, helping you make good decisions and avoid the bad decisions and not mess it up, and doing the smart things around asset allocation, diversification, and regular rebalancing. The core portfolios is where we are based on your long-term goals, and we buy and we hold this for the long term. We use predominantly low-cost index funds to get exposure to all the different sectors in there, with a couple of exceptions which we'll talk to you about. But predominantly for the share investing, it's low-cost index fund and hold. And this will be up to 25 to 80% of your portfolio. The active component is where we're trying to smooth out some of the downside. Now, this is a diversified portfolio also of index funds. It does include gold in this case as a defensive asset. Now, for most of the time, we hold this for the long run, but when we hit what we think is a FOMO stage, we're ready to take some profits in this. Now, the FOMO stages can run for a long time, so we don't want the whole strategy, including your core investments in this, but we are willing to take some profits here, and we can talk to you more about how we do that exactly, but it's a process that helps take some profits out of the market when we've run hard and we're approaching those FOMO stages. For our retirees, it's very important that they have adequate reserves. So for you accumulators, that's not what you have while you're accumulating. You're dollar cost averaging as a means of protecting and making sure you've got access to some cash reserves and line of credit. But once you get close to retirement, we'll start to have 4 years worth of your spending needs. So if you're going to have $100,000 a year of income in retirement and you've got a $2 million portfolio, we would have $400,000 in low cost investments. That's cash, that's term deposits, that's short-term bonds that have a very low risk, and that's where we're pulling the investments out of. It's like filling up the cupboard for a long winter, and it means we don't have to worry about what the markets are doing in the short term for getting your cash. And if you remember those 3 ways to lose money, having to sell was one of them, so we make sure you never have to sell in a bad time so that we can ride through those periods of downturns and get the long-term returns. And lastly, enhanced returns, where we run a portfolio of direct Australian shares and international shares, where we're chasing a little bit of higher return, a little bit of higher interest. You can see these, you'll have a portfolio and see under the bonnet, and we're particularly chasing the benefits that come from the dividends and the rising income, and for us Australian investors, the tax benefits that come through franking credits. So that's our care process and our investment process. In summary, personal financial plan always comes first, and for those of you that have started that process, I applaud you again. For those of you that haven't, I'd urge you to once again go back to our videos, go back to our website, feel free to book a wealth potential meeting, but congratulations on those of you that have started planning and have made it all the way to the end of this video. Investing is a critical part of that plan. Investing can be complex, and we're not designed to be good investors, and that's why you need a good investment process that's based on those foundations. Those 4 foundations, particularly that behavioural approach with regular review and coaching from someone that supports those foundations, that will let you know when you're about to make a prehistoric decision rather than a rational decision, and that will keep you on track and keep your goals up to date. Thank you for listening, and lastly, that are literally going to keep you on track and achieve your goals. Thank you for your patience in getting through this. It is a complex and important subject. Some of you will want to know more information, and always happy to talk in detail. Some of you may have questions, and we'll talk about that at your next meeting and as part of presenting your statement of advice. And as always, don't act on this until you get that statement of advice. Thank you for listening.